Dear viewers, no doubt the season has changed now. People were talking about Sensex climbing newer heights. Where are we now? We are seeing new lows day after day. The headlines which were talking about where the Sensex is heading to has been replaced by how many lakhs of crores of rupees the investors have lost in the stock market. It asks the question, are you really a loser in the stock market? Have you really lost a lakhs of crores of rupees in the stock market? Let me try to analyze the situation today and find an answer for this question. Have you really lost money in this market crash? This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, a practicing financial planner.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, before we try to analyze whether you have really lost money, to be a successful investor, it becomes very essential for you to understand the meaning of two terminologies. These two terminologies are the words volatility and the word loss. Volatility is movement of prices up and down. Movement of price up and down is fairly common, and it keeps happening at every stage. There is a change in prices on a daily basis, there is a change in prices on a month-on-month basis. Sometimes there will be a seasonal variation. Seasonal variations are more pronounced. They may rise very fast, like in a bull market, or they may fall very much during a bear market. Forget about the stock market. Let's look at the real life examples now. Now, if you take the case of agriculture, you would have seen commodities like tomatoes or onions. So the prices hitting the roof and prices falling to the ground. Both are perfectly common. So this is called the volatility of the prices. Now, is volatility a loss? The answer is volatility is not a loss. Volatility is just the prices quoted for a particular object, commodity, or an asset at any point of time. A loss results when you try to sell it when the prices are low. Let's take the example of a commodity where you have purchased it for 100 rupees. And because of the volatility, the prices have dropped now to 80 rupees. Now the prices, if you try to sell in the market, you have to sell it at 20 rupees loss. So this is called the volatility. The loss results only when you sell this at 80 rupees and book the 20 rupees loss. If not, this is a notional loss. A volatility gives an impression that you have lost money. It is not real loss, but it is a notional loss. A notional loss becomes your real loss if you sell it out of compulsion, or sell it out of panic, or sell out of without knowing what might happen going forward. So please do not equate volatility and loss in the same way. These are two different terminologies. You need to know about it. So the world will create a panic in you, telling that you have lost so much of your money and you stay invested there. Probably more losses would follow. The losses will follow not because of the volatility. Losses will follow only because of your panicky action. Otherwise, you just have to live with it. Volatility in prices is like seasons. So there are always seasons. The world is cyclical in nature. Sometimes we experience summer and some months we experience winter. Likewise, sometimes the prices go up, sometimes the prices will come down. Bull markets are also real and the bear markets are also real. As a seasoned investor or an informed investor, you should know how to stay calm and how to make most of this particular movement in the market. One question that comes to my mind is volatility good or is volatility bad? Volatility is here to stay. Is it good or bad? Let's take another example. Is electricity good or is electricity bad? We cannot imagine a life without electricity. At the same time, we can't go and hold a live wire and electrocute ourselves. So the way you have to handle this problem is, how do you handle volatility? If you know how to handle volatility, instead of volatility being the dangerous word, it can become your servant which serves your purpose. You should know the art of making volatility work for you. That is where volatility will be converted into a useful servant for you. Investors react to volatility in stock prices with fear. Whereas they deal with volatility in other fashions with other subjects that they deal on a day-to-day basis. And they are never worried about the volatility in those items. For example, gold has volatility. Land prices can move up and down. But I haven't come across one single person or one single lady who has felt bad that she purchased gold when the prices were high and subsequently the gold prices have fallen down. No, they are just not worried about it because they feel gold prices will come back. Similar story follows in case of land too. Whereas when it comes to question of stock markets, they feel that they have lost money and they feel that they have made a bad judgment by investing in the stock market. Will people really lose money in the stock market because of the volatility? The answer is no. I'll take the recent example of the last 2 decades. In 2008, the Sensex was at 21,000. The volatility, the bear phase, the correction brought down the Sensex to a level of 8,000. That means the Sensex at an index level lost 60% of its value. This I am talking about in the recent past, 2008. But where are we now? At 52,000. Where were we now? A few months before, we were at 62,000. Somebody who has seen 21,000 was worried about the volatility and they lived with that volatility when the Sensex came down to 8,000. But their patience paid and the Sensex rallied all the way up to 62,000. Even after the present correction in 52,000, they are literally 2.5 times more than what they have seen in the year 2008. Even in case of stock markets, if you have time, the volatility will not affect you. It's just a matter of time. The Sensex will also regain and conquer previous heights. Now that we know that volatility is not a loss and volatility is a reality of life and it exists, how can we make it best use to our advantage? To make best use of volatility, the first thing that we have to know when we venture into the stock market is volatility is real, it exists and it exists on both sides. Volatility you can see on the upside, extremely fast up move like what we saw between 2020 and 2022, Sensex rallying all the way from 27,000 to 62,000, which is an volatility on the upside. Now, if you are seeing 62,000 to 52,000, it's a volatility on the downside. Understand that we have to live with volatility. This is the first knowledge that you should have. Then only you will become masters in the stock market. Once you know that the volatility here, then how to conquer it? Very simple. Don't buy everything on one single day. We call this concept as time diversify. That means keep buying at regular intervals of time. You have seen systematic investment plan, or you would have seen your financial planners or advisors telling you keep investing at regular intervals of time. When you do a time diversification and when you commit an equal amount of money at different points of time, the prices of stocks or the mutual fund you purchase gets averaged out. One another way where you can make volatility your best friend is to keep your investment horizon as long as possible. If you are an investor in the stock market, the minimum time horizon that you have to keep in mind is 5 years. If you are a person who has come here with 1 year, 2 year, 3 year time horizon, anything could happen. You may lose money, you may gain money, anything could happen. But if you have longer time span of 5 years and more, it is very reasonable to expect that you will walk out of the stock market as a winner. In spite of all the knowledge of volatility and notional loss, at times volatility can create trouble for you. You should know what can create problem for you or what can create real losses for you in spite of all the precaution that you might take. One thing I can tell you for sure is your research should be top class, or you should be working with good financial advisors. You may be having a long-term horizon, but if you have picked up a wrong stock or a wrong mutual fund, even with passage of time, you may still lose money. So research well, make sure you buy something which is of good quality. Likewise, as I already said, you should have a long time horizon. Any in the short term of 1 year, 2 year, 3 years, anything could happen. Longer the time frame you have, chances of you losing money because of volatility is lesser and lesser. A time frame of 10 years and more, it makes absolute sense, and the volatility works as a friend for you. While I told you what volatility can do for you, it is equally true that at times volatility can also harm you. You should know what you should do to prevent losses that might come because of volatility in prices. Number one thing that you should do is always research well. You should know what you are buying. Whether it's a stock or a mutual fund, you should make sure that you are buying something which is of good quality. If it is of a bad quality, the volatility can completely dent the prices, and those prices may not come back to you at all if it is of poor quality or if it is of doubtful quality. Likewise, in the short term, anything could happen. Keep your time horizon long enough. One another reason why volatility can create real losses for you is because you are leveraging. That means you are buying more than what you can pay. Your stockbroker would have given you a credit line, or you would have placed these stocks in a bank and you have purchased, hoping that tomorrow, next month, the stock prices will increase and you will be able to get a higher profit than the normal profit. Instead of your calculation, the prices fell, then the stockbroker will ask you to pay the margin money, or the banker can ask, put the margin money, or they are going to liquidate the stocks. So what is a real volatility in that case gets converted into a real loss, because the notional loss is getting converted into real loss because the person who gave you that credit line will be liquidating those stocks. One of the best way to stay safe from volatility is to build a portfolio which minimizes the volatility, or which makes volatility as a friend for you. You can build these by creating proper mutual fund portfolios, a portfolio which has conservative funds, a portfolio which has hybrid funds, a portfolio which is built out of funds which do not exhibit such a high level of volatility. And to do this, you need a professional help. If you have an interest to build portfolios which can minimize volatility and reduce the chances of loss, you can make best use of our services. See, we have a team of financial planners who are here to help you out. If you have an inclination to make best use of our services, all that you have to do is send us a WhatsApp message on the number that is shown here on the screen, or just fill your details in the forms which is given in the description box, and one of the financial planners working with us will get in touch with you, help you to build a robust portfolio which has less volatility. So why delay? Take an action now. Send us a message now. Dear viewers, hope the episode that I have done helped you to understand the difference between volatility and what is a real loss. Next time when you see a television headline or a newspaper headline that the people have lost money, take it with a pinch of salt. If it helped you to understand the difference between the two, please like this video. If you like this video, don't forget to share this video with your friends and relatives. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with another insightful video in yet another video very, very soon.
Press the bell icon for more details and subscribe our channel.